So, over the last couple of days, markets have gone haywire, particularly starting yesterday afternoon. Gold and silver started plummeting today and yesterday. Bitcoin has dropped and plunged by nearly 10%. The Wilshire 5000, which is the aggregate stock market, dropped by 1,000 points or nearly 2% in the past several days. And interest rates have increased and remained elevated. Now, part of this has to do with the expectation that the Federal Reserve is going to engage in less expansionary monetary policy, aka they're reducing asset purchases, which over time will increase the interest rates on the short end and the long end. But something else was stated here by the Fed in their minutes in the middle of December. And during the minutes of their last Fed meeting, they made an interesting statement that started spooking investors. Okay, and it was a discussion over what they call policy normalization. So the Fed is nobody's fool. They know that the measures that they have undertaken to stimulate growth in the economy are what are called extraordinary measures. They're lowering interest rates well below any type of normal nominal range. Quantitative easing, even though they don't like to call it quantitative easing, and asset purchases that blows up the Fed's balance sheet is not considered normal. So now there's been the discussion that with such high price inflation going on, how do they proceed to a more normalized system inside of the Federal Reserve and the banking system? And there they talked about certain approaches that they would take. One of them was removing policy accommodation. Let me translate that for you. That means reducing and stopping the asset purchases, which they've been planning on doing so. The timing and sequencing of such normalizing actions. And then the last part here is the appropriate size and composition of the Federal Reserve's balance sheet in the long run. Now, here is where the discussion needs to be held right here, because the staff reviewed the previous normalization episode, including how the committee commenced normalizing by raising the target range for the federal funds rate. They're talking about what Jerome Powell did back in 2017 and 2018. And then reducing the Federal Reserve's asset holdings in a gradual and predictable manner, as well as the timings of this step of these steps, okay? So they're discussing on how to not only raise the federal funds rate after they reduce asset purchases, but to actually start reducing the Fed's balance sheet, okay? Now, the Fed's balance sheet, which is composed nearly all, 6 trillion of this is composed of U.S. Treasuries. Another good portion of this is composed of mortgage-backed securities. The Fed is sitting there with all this debt, and they don't know what to do with it. Now, what they tried to do back in 2017 was sell this debt back to the banks. So they liquidated about $700 billion back to the banks, and that started to cause the banking interest rates to go haywire, particularly in the repo interest rates. The secured overnight financing rate shot up in a matter of days from 2% to over 5%, and in certain ranges it actually exceeded 5% and was pushing 10%. But this is the overall aggregate secured overnight financing rate. And if it weren't for the Fed to step in and start entering inside of the repo market and started to purchase those treasuries inside of the repo channel, that's what we're going to call it, the repo channel. They started purchasing these treasury securities, and then they would sell them back out to the market after a few days. If they did not enter in and start purchasing this right here, and you can see how every day they were purchasing tens of billions of dollars of treasury securities and putting it on their balance sheets, even if temporarily for a day, and then trading that out for cash to provide the necessary liquidity. These interest rates would have spiked up, and they would have pushed up the federal funds rate, and it would have raised the cost of borrowing, and it could have caused a freeze in the banking system and collapsed the entire economy because everybody was frozen on their financial assets. There was no way to get that needed liquidity out into the market, okay? Now, consequently, because the Fed was selling assets back to the banks were holding reserves stocked away at the Fed. So they have accounts at the Fed, the major banks do. And what the Fed was doing was selling treasury debt that they had purchased from the banks earlier on. They were selling it back and just swapping it out for these reserves. So far so good, but once the reserves dropped down to about 1.5 trillion, that's when it started causing systemic problems in the banking system, because we have to remember this is an aggregate number. Some banks started getting less on cash and needed cash for temporary operations, and they were trying to go out into the market and start trading their treasuries that they had sold to them by the Fed to another bank, and no other bank was willing to accept those or even lend the money even on a temporary basis because they were getting hit with treasuries. And then in the third quarter, there was a huge corporate tax payment that was paid, so accounts were drawn down at the banks as corporations were forced to pay the federal government a tax. And then at the same time, simultaneously, the federal government ran a record deficit that quarter, so they were unloading treasuries to the banks. So the banks were getting hit with all of this collateral and debt and squeezing and sucking out liquidity being used by the government, and that nearly crashed the entire banking system, combined with the Fed unloading assets. Well, now the Fed is talking about doing that again. And so now markets are getting a little anxious on this, okay? So everything has dropped down. Your precious metals, your cryptocurrencies, your stocks, your bonds, everything is going, and they're all flocking to cash. Now, wait a second, you might say. Didn't I just tell you a few weeks ago how I was saying that when you see that the bond interest rates go up, money would flow out of the stocks and cryptos and the bonds, and then eventually go into precious metals? Yes, that's true. But you have to remember now, that during the initial phases of this, the flock will be to cash. And the reason why is because cash is more liquid than gold. They're still flocking to cash because they're still thinking that this is temporary. It's only when it becomes ingrained inside the investor mindset that the instabilities of the economy are not going away will that cause the flocking to gold, okay? So when 2008 happened, right, and the banks were being squeezed in liquidity, caused by the rising of interest rates earlier, and then toxic mortgage debt that was no longer being repaid back, and the debts were coming due, they were selling their holdings of gold and what they had gone out and purchased on the financial markets of gold, and that caused the gold's financial price to actually drop by some 30%, okay? So, we could see that again, but we're not going to see that nearly to the extent. We're not going to see gold drop by 30%, all right? And the reason why I say that is because, as I have alluded to in earlier videos, gold is really at near a bottom of its valuation compared to the money supply, whereas in the 2000s, it wasn't near its bottom. So in other words, the bandwidth for precious metals to drop is just not there. Now, gold could drop, and theoretically it could drop to, say, around 1,700, maybe 1,650, but it's really not going to drop below that, and silver will follow a suit on this. So while silver and gold plunged today, when we take a look over the last 7 days, the silver price has not really dropped all that much, okay? It's really more or less a little bit flat, a little bit on the downward end, yes, but not a huge significant drop, and so therefore the wealth preservation effect of precious metals is still going to take effect. But what about the Fed's strategy here? What about their strategy of normalization? If they try to sell assets back to the Wall Street banks, that failed once before. What happens if they do it now? Are they going to incur a crisis of the banking system just like they nearly did in 2019? Well, at first I thought yes, and I panicked as well. I was like, oh my God, I'm glad I'm holding precious metals right now because this is going to be crazy. But when I started doing an examination here, I realized that what the Fed has been doing for the past 6 months has been selling numerous treasury securities out onto the markets through the repo markets. Now, this is the Fed selling treasury securities, and they are selling to the tune of $1.5 trillion of treasury securities to the banks today, daily, okay? So the Fed is seeing that there's too much liquidity inside the banking system, and so they're unloading $1.5 trillion. Now, granted, this $1.5 trillion of treasuries are being repurchased every few days or so, so this is not wiping out the bank's balance sheets by any means, nor is it changing the balance sheets and the assets of the Fed. But what they are doing here is trying to drum up any kind of rise in the short-term interest rates on the federal funds funds and the secured overnight rate level, because the secured overnight rate is so low that it's actually too low for the Fed's own comfort here, okay? The Fed funds rate, as I noted here in my last video, was piling down at about 0.08%, but the channel that the Fed wants to hold the federal funds rate in is 0 to 0.25, which means that the Goldilocks scenario is where the federal funds rate is trading at 0.12 to 0.13%. Well, 0.08 is lower than what the Fed wants, and the reason why is because this secured overnight financing rate, which is driven by the repo markets flushed with cash, is what's keeping these interest rates so low. But so the Fed is selling trillions of dollars of treasuries every single day temporarily and then rebuying them back, trying to push up those interest rates. So what I'm gambling on is that, and I think is that the Fed is gambling on, is I'm betting that the Fed thinks that if the banks can absorb this on a temporary basis, they could probably absorb some of these assets on a permanent basis. So maybe the Fed will never go back down to, say, $4 trillion of assets. Certainly the banks don't have the reserves for it, but the banks do have about $4 trillion of reserves. So the Fed's probably thinking that with $4.2 trillion of reserves sitting at the banks, it could probably safely sell $1.6 trillion of permanent treasury securities, ramp down and tap down the need to sell repo treasuries, okay, on the repo markets, and simultaneously reduce its balance sheet as well as reduce the reserves at the banks without causing permanent harm to the liquidity that is needed to maintain financial operations in our economy, okay? Now, why would the Fed care about doing this? Well, one of the reasons why the Fed does this is because, first off, they're alarmed by the inflation rate. The fact that the Fed is discussing doing this, which would raise interest rates on the long-term end, not just the short-term end, tells you that they are very concerned about the consumer price inflation rate, and apparently from what they're seeing, it's only going up. The second thing is that the Fed treats this like ammo. The more that they have on their balance sheet, the more bloated their balance sheet is, the more constrained the Fed feels like it should be from intervening in the markets further. But if they start selling some of these assets back onto the market, and then the economy gets into a situation where the Fed needs to stimulate the economy with more printed money, the Fed feels like, well, they can just expand their balance sheet back again because they reduced their balance sheet earlier. So it's not a system of ever increasing assets on the Fed balance sheet. To them, in their minds, it's a pattern of controlling the interest rates on the economy to stimulate growth. Here, the interest rates are too low, inflation too high. They're going to try to reduce growth, reduce the demand for loans by making interest rates on the short term and the long term end go up. How are they going to do this? By selling these assets back out to the banks and forcing the banks to hold on to more of this debt, while at the same time looking and reviewing the reserves at the banks and probably gauging that they shouldn't go below this critical threshold level where the government has been running record deficits lately, and it will draw on the demand of these reserves because there's another institution that uses these reserves, not just the Fed, and that's our government accounts. The General Treasury account actually draws upon reserves when it needs to borrow money from these banks by auctioning it off, and these reserves help ensure that these banks can help and demand for those loans, which is why the government is able to send out hundreds and hundreds of billions of dollars every quarter, and we don't ever see none the wiser in why interest rates are not skyrocketing up into oblivion. Now, eventually that's going to change, and with that changing dynamic, thanks to the Fed's actions, it's going to cause certain changes on policy levels by the Republicans and the Democrats inside Congress and the presidency, but that's a story for another day. The meantime, what the Fed here is doing here is that they are very concerned about the inflation rate. That's for certain. What they're seeing in their own analyses that they have been performing and the data that they've been collecting is that the inflation rates are not cooling down. So they are taking a more serious tone, at least, into combating this inflation rate. Yet with the inflation rate at 7% right now, measured by the Consumer Price Index, then we're still having negative interest rates, and having a little bit less negative interest rates really isn't going to cut it in the long-term end. So in the meantime, the play for me advising you is still precious metals. in if anything, to be the least one to suffer the least amount of losses right now. If you hold cash, you're going to lose to consumer price inflation. When you hold a precious metal, you own that item. Nobody duplicates precious metals, okay? That item will increase in value over time as gold has historically done. You can see this when you just take a look at the years and years left of data. You can see how gold has climbed over time. Even when it goes into long periods of lulls, it will climb and it will increase in value, and so will silver in such a manner, if maybe not quite as stable as gold will, okay? So keep that in mind. Now, again, I'm not a certified financial advisor. There are still plays to make within the stock market to go into safe investments. The flight to safety has begun, right? But what the investors are doing is misvaluing where the safety is. They think right now the safety is holding cash and dollars until this whole thing blows over and then rotate back into stocks and bonds. When that becomes a situation, when they wake up and realize and say, wait a second, we might be going through a huge collapse in the economy from all this because the Fed's raising rates too high. Not that I think that this is going to collapse it right away. That could then cause that flight to gold and silver. Any type of instabilities in the global markets can cause the flight to gold and silver and the abandonment of cash in the end. Not that I want the dollar to be destroyed and decline. I just call it like I see it. Without a massive deflation going on inside of the dollar has been constantly being devalued. The dollar now is the overvalued asset. It's now the bubble. Bitcoin, the most speculative asset, and cryptos as well as Ethereum have been collapsing in the last few days. If interest rates continue to spike, those cryptocurrencies will collapse because, in my opinion, they're the most speculative asset. Next will come stocks following up on its heels. Now, they may not collapse like Bitcoin and the cryptos will, but we will suffer a bear market in stocks. And then will come the dollar, and then will come the rise in gold and silver, okay? That's how I see it right now, and I'll keep, trying to guide you and tell you where I think that we're heading inside the markets. But right now, it looks like the markets in January are off to a bang and not in the good way. We could be seeing the beginning of the bear market commence, as I have predicted and have been predicting for the past 6 months. I may have been a little bit early, but I don't think I'm wrong in this. Anyway, guys, thank you for watching this video. That's all that I have. If you like the content that I produce, make sure you just click that like button, subscribe to my channel, click the notification bell if you want to be notified when I upload any kind of new content to YouTube so you're the first to see this. And let me know what you think. Comment on this. This stuff is very complicated. If there are things that you want me to elaborate or elucidate more, I'll be happy to do so. If there are questions that you have, drop some questions. I'll try to get by to them, or I'll produce a video on them to answer your questions, okay? And guys, just stay tuned. I'll probably produce another video this weekend. And then remember, the inflation numbers are going to come out next week. I'll definitely produce a couple of videos on that. One for the producer price index, one for the consumer price index. And also that will help give us some more insights on what's going on in our economy right now. So more than anything, guys, just try to protect your wealth right now. It's definitely time to be in a wealth protection scenario until we get back to a more normal functioning market, if we ever get back. Once again, guys, thank you for watching this video, and I'll talk to you next time.